Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from Good Returns on the 4th of March, rise in retiree renters to influence data in decades to come. Topic number two from New Zealand Herald on the 4th of March, what is New Zealand's biggest KiwiSaver balance? Topic number three from RNZ on the 5th of March, number of pensioners needing rent help nears 50,000. Topic number four from One News on the 6th of March, modest growth in property values in February from CoreLogic. And topic number five from Good Returns on the 6th of March, longer term mortgage rates near cycle lows. So first up for this Week in Review from Good Returns on the 4th of March, rise in retiree renters to influence data in decades to come. The Massey University Retirement Expenditure Guidelines, published annually, offer valuable insights into how retirement is unfolding for the baby boomer generation. However, Associate Professor Claire Matthews, the guidelines author, notes that the impact of renting in retirement is not yet fully reflected in the data. Currently, most retirees are homeowners without mortgages, which significantly influences their spending patterns because obviously they don't have a mortgage to pay anymore. Matthews predicts it will take at least 5 years before the data begins to reflect a higher proportion of retirees who rent. Christine Hay, a Hawke's Bay financial planner and chair of FAN's Financial Planning and Investment Member Advisory Committee, points out that advisors can usually determine whether their clients will own their own homes in retirement. If home ownership isn't feasible, advisors must account for rental costs and financial planning rather than relying solely on broad data trends. Matthews emphasised that younger generations should seriously consider their home ownership prospects and whether they'll have their mortgage paid off before retirement. Without property ownership, a larger portion of their income will need to be allocated to housing expenses, potentially limiting their overall spending capacity. So, my opinion on this is that while I think it's great for people to have the option to rent when they're younger, certainly the sooner you get your foot on the property ladder to purchase your own home, the better. Because these days it does generally take about 30 years to pay off your mortgage, although you can pay it off faster if you've got enough income and you're pretty good with your money management. If you're not good with your money management, you can learn. It is a learned skill. So don't give up, and don't give up on your dreams of owning your own home. If you know younger people, let them know that the sooner it is that they get started, the easier it is. And so really encourage our younger generation to make a real concerted effort into putting the effort in to purchase their first home sooner rather than later. Topic number two from the New Zealand Herald on the 4th of March, what is New Zealand's biggest KiwiSaver balance? New Zealand's largest KiwiSaver balance is estimated to be close to $3 million. A survey by RNZ found that most KiwiSaver providers were reluctant to disclose details about member balances. However, several reported accounts exceeding $2 million. Fisher Funds and KiwiWrap confirmed members with balances over 2.6 million, with KiwiWrap's highest balance falling between 2.6 million and $3 million. Data from actuarial firm MJW showed that KiwiWrap had the highest average member balance at $173,300 in the previous year, compared to the overall scheme average of $33,500. KiwiWrap's managing director, Scott Allman, attributed large balances to one-off contributions and transfers from Australian superannuation savings. To accumulate $3 million from scratch in KiwiSaver's 18-year history, an investor would need to contribute about $5,000 a month with a 10% return. Pi Fund's chief executive, Anna Marie Lockyer, noted that the largest KiwiSaver balance exceeded $2 million. She explained that such a sum positioned individuals well for retirement, with a $2 million balance potentially growing to $10.1 million or $7.5 million when adjusted for inflation over 15 years with continued contributions. Lockyer emphasised that consistent contributions, selecting the right fund based on life stage, and regularly reviewing your investment settings were key factors in achieving substantial balances. She also highlighted that broader policy changes were necessary to improve KiwiSaver outcomes, praising Finance Minister Nicola Willis for reviewing contribution settings to ensure that the scheme remains a vital complement to the New Zealand superannuation. Lockyer pointed out that individuals with high balances benefit from the portfolio investment entity PI tax regime, which caps tax at 28%, compared to the 39% PAYE rate. ANZ, which is New Zealand's largest KiwiSaver provider, reported members with balances over $1 million, but noted that the average balance was around $33,000. ANZ Investments Managing Director Fiona McKenzie emphasised KiwiSaver's growing role in financial security, whether for home ownership or retirement. She encouraged investors to ensure that they were in the right fund, contribute regularly if possible, and assess their risk level. While approximately 370 people under the age of 25 have KiwiSaver balances exceeding $80,000, more than 38,000 individuals aged 61 to 65 have less than $10,000 saved. So, there's definitely room for improvement. And I completely agree that it's really important to be in the right KiwiSaver fund for your age and stage and the level of risk that you feel comfortable with. But also it's important that you're in a KiwiSaver fund that performs above the average as well. So this is something that I do for our clients at Property Apprentice. I make sure they're in a good KiwiSaver fund because it can play such an important role when it comes to financing your retirement. If you'd like to learn more about investing in property and investing in general, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor, and these events are available live online. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no obligation phone call or meeting with my husband, Paul Roberts, via the website. That's propertyapprentice.co.nz. Topic number 3 from RNZ on the 5th of March, number of pensioners needing rent help nears 50,000 people. Nearly 50,000 pensioners in New Zealand receive an accommodation supplement to help cover housing expenses, and that's a number that's expected to keep rising. The accommodation supplement, which varies based on income, assets, and accommodation costs, assists with rent, board, or mortgage payments. The maximum amount a single person without children can receive is $165 a week. Data from the Ministry of Social Development shows that as of December 2024, 48,789 people receiving New Zealand Super also received an accommodation supplement. That's an increase from 47,223 in December 2023 and 34,279 in December 2019. In total, 928,029 people were receiving New Zealand Super. Simplicity Chief Economist Shemabel Yaqub noted that while the proportion of pensioners receiving housing support remains steady at around 5%, the overall number continues to rise as more people retire. He pointed out that discussions about the future cost of an ageing population often focuses on healthcare and New Zealand Super, overlooking housing-related expenses, which are also significant. Yaqub explained that when New Zealand Super was initially designed, higher home ownership rates were expected to ease financial pressure on retirees. However, with more people reaching retirement age while still carrying a mortgage or without home ownership, the burden on social assistance is increasing. Yaqub argued that New Zealand Super should be recognised as a form of welfare, costing the country $20 billion last year. That's an increase of $2 billion from the previous year. He suggested that rather than being universally available, it should be targeted towards those in genuine need, allowing for better support for vulnerable pensioners. He also highlighted the challenge of funding these growing costs, especially in an era of fiscal restraint. Treasury has begun considering these concerns, as reflected in its research on government spending across different age groups. Westpac chief economist Kelly Eckold noted that while rising housing support costs for seniors may not significantly impact government finances in the next 3 to 5 years, they could become more substantial over the long term. Housing assistance currently totals about $2.5 billion, including support for pensioners, and it's expected to increase as the ageing population grows. Eckold suggested that Treasury will likely address this issue in its upcoming long-term fiscal report due later this year. My opinion on this is that it is a real issue that New Zealanders are going to have to face. So again, the sooner you get into a property for a home, the better. You really do need to prioritise home ownership because it makes such a huge difference in retirement if you're not paying a mortgage or paying rent. I mean, let's face it, rents aren't likely to decrease over the next few years, are they? And mortgages are often difficult to fund, especially when you're no longer earning an income. So make it a priority, sort yourselves out. And I would love to see New Zealanders being in a position where they didn't need the superannuation. So exactly like they said, if the superannuation was only available for people that really needed it, how great would that be? Don't rely on the government to fund your retirement. Sort yourselves out. And if you want help with that, we're here ready and rearing. Topic number 4 from One News on the 6th of March, modest growth in property values in February from CoreLogic. New Zealand property values rose by 0.3% last month, according to CoreLogic's Home Value Index, signalling the end of last year's market downturn, which was a modest downturn, to be fair. Some people would call it completely flat. I'd be some people. Chief Property Economist Kelvin Davidson noted that the increase aligns with previous indications of a return to growth. Between March and September 2023, values declined by 4.1%, followed by slight fluctuations from October to January. The recent increase is the strongest since a 0.5% rise in January 2023. Property value changes varied across major cities in February. Tauranga saw a decline, while Christchurch, Dunedin and Hamilton recorded increases. Auckland values rose by 0.3%, Wellington by 0.1%. Regional areas experienced mixed results, with gains in Napier, Nelson, Rotorua, Gisborne, New, Plymouth, Invercargill and Queenstown. Meanwhile, declines were recorded in Palmerston North, Hastings, Whangarei and Whanganui. CoreLogic highlighted that while market trends indicate recovery, property values may not increase uniformly across all regions. That's certainly something that's been our experience over the last 25 plus years being in the property market in New Zealand. Some areas will perform more strongly than others, and some areas will be recovering, whereas others might still be having a downturn. Davidson attributed this variability to higher than normal property listings, though falling mortgage rates are expected to drive moderate recovery nationwide. Davidson suggested that while rising values may benefit homeowners, affordability remains a challenge for aspiring buyers. Despite improving conditions, he downplayed the likelihood of a dramatic market boom in 2025, citing debt-to-income ratio restrictions and an abundance of listings as limiting factors. My opinion is that it's not so much the DTI restrictions that are going to really have an impact. It's more the fact that we've still got an economy that's in some serious trouble. So it'll be interesting to see what a change of Reserve Bank governor will do for that area. We might see some restrictions easing a little bit, which could certainly make it easier for some people to get on the property ladder or climb further up it to fund their own retirement and provide rental accommodation for people that desperately need it. He projected that values might not increase every month across all areas, but anticipated a gradual upward trend due to declining mortgage rates and a stabilising economy. Investor interest is also rebounding, aided by the upcoming full reinstatement of mortgage interest deductibility from April 1st. While first-home buyers may still find opportunities, Davidson noted that values remain significantly below post-COVID peaks. A more dynamic market could also benefit owner-occupiers looking to sell and move forward with new purchases. Overall, he predicted that 2025 will see more property sales than 2024, alongside rising values, though the growth is expected to be more measured compared to past market upswings. My opinion on this, and this is something that I've been quite vocal with, is that I don't think we're going to enter into the next boom until the economy is much stronger and people are less concerned about whether or not they can lose their job or whether their employer is going to go broke. So, yeah, I think we will see growth this year, but it is likely to be pretty modest. Things can change quickly in the property market, though, and with interest rates coming down, it's certainly going to make it more affordable for some people to get their foot on the property ladder. So, it's all about supply and demand at the end of the day. At the moment, plenty of supply, not that much demand from buyers. So, it's a good opportunity to get into the property market right now. Topic number 5 from Good Returns on the 6th of March, longer term mortgage rates near cycle lows. ANZ's latest property focus report suggests that for long-term investment rates to decline further, the OCR would need to drop below 3%. That's the official cash rate. However, with the bank expecting a 3% low for the official cash rate, mortgage rates are believed to be nearing their lowest point this cycle. Historically, mortgage rates have only fallen significantly below 5% to around 4.5% when the OCR dipped under 3%. Since neither ANZ nor the Reserve Bank anticipates that happening, a sharp drop in rates remains unlikely. ANZ Chief Economist Sharon Zollner advises mortgage holders to carefully evaluate their options when transitioning from floating to fixed rates. According to the bank's calculations, fixing for 1 or 2 years may be more beneficial than waiting for a potential rate drop. For those considering breaking a fixed-term mortgage, Zollner recommends weighing penalties against potential long-term savings. She also suggests diversifying loan terms to spread risk, noting that while it prevents getting the timing perfectly right, it also reduces the chances of making a costly mistake. The unpredictability of events like COVID reinforces the importance of this strategy. The housing market began 2025 on a similar note to late 2024, with modest price increases in January and a dip in sales volumes. While new listings surged, keeping stock levels high and limiting short-term price growth, ANZ expects momentum to build throughout the year. The bank forecasts a 6% rise in house prices by year-end. Despite improved purchasing affordability, prices remain high relative to incomes, which may cap growth unless housing supply increases. Looking ahead, ANZ predicts a 5% rise in house prices next year, slightly outpacing income growth, with a more stable 4.5% increase expected in 2027, aligning with household income trends. With mortgage rates stabilising and house prices expected to rise, now's the perfect time to get ahead of the market. Join me at one of our free events called How to Succeed with Property Investing. These events are available online, so it doesn't matter whereabouts you live. Watch it from the comfort of your own home, and we'll help you gain valuable insights and learn strategies tailored to today's market conditions. Whether you're an experienced investor or just getting started, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving the financial success that you are after. In our free events, we'll also tell you more about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up for one of our free events. If you've already been to one and you'd like to know more about how we can help you on your journey, make sure you book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. That's free as well. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.